Matt Lee joins us here, and we welcome him. We're talking rental properties. So this is if you have, you want to buy a house, maybe depending on the amount of bedrooms, rent it out, the pros, the cons, what it's going to cost you, what it might net you.
Yeah, so we're going to talk about kind of a setup that my wife and I look at when we're looking at buildings, and what I do with clients of my own, where we kind of go in and we have to say, you know, we're looking at a blanket of numbers. We want to know what we get from the seller so that we can kind of break down what we want to use, utilities, taxes, and all of these expenses, and what's the income. And what also you would look at is what the potential income is as well. So I mean, if we were to go down through the list and break down bit by bit, you kind of start at the income, and then we go from there.
Okay, there's a lot to be to concern yourself with.
Yeah.
Revenue here, first of all.
So yeah, so revenue, you've got a 6-unit building, $1,000 a month for each unit, $72,000 for the year. You add the $500 for laundry if you have the laundry machines. You've got $72,500 for a total revenue, gross revenue.
Okay, but it's going to cost you to do all this.
It's going to cost you, and you know, and that's the concern is that we always say keep a separate bank account for rentals, where the mortgage comes in and where the rent comes in, because when people start collecting rents and all of a sudden they have $1,000 here and $1,000 here, and all of a sudden it's like, oh, well, you know, yeah, this is going to cover my mortgage and I'm going to keep this in my pocket. And all of a sudden they say, hey, I've got expenses to cover. And it's like, well, no, you didn't really have expenses to cover. You spent the $1,000 that came in on the rent, you know. It's just one of these things that you want to make sure that you keep everything separate. It is a small business.
It's maintenance, it's insurance.
It's everything, because you are looking at something where you say, okay, well, I've made a surplus this year. And you say, okay, well, I've got this amount of money. I'm going to go buy something for myself, or, you know, first of all, that's going to be claimed as income against you. Second of all, you know, you're going to need a roof down the road, or you're going to need baseboards down the road, or you're going to need a new driveway or furnaces. There's always something. So expenses, I mean, and the thing is you say, well, I made a couple $1,000s this year, and 5 years down the road, a roof costs you $8,000, you know, and ballpark numbers, you know, depending on how big the house is. But you want to make sure you've got that money set aside so that you're not pulling out of your pocket, because then it becomes frustrating.
Okay, now that same bit of information here we just showed you, we'll do the expenses here.
Yeah, so we've got the utilities, the taxes, the insurance.
Management, maintenance,
so
combined.
$94.80. We've got the $25,680 as a total expense against the 72. So you've got the 72,500 coming in, but you're expending the 25,680 before you spend on your mortgage. So you've got to really remember that these are the expenses that are happening. So you've got this net operating expenses of 46,820, which is the money after you've spent on your utilities, your taxes, your maintenance. Then basically you take the average price of $700,000 for a building like this, and you're coming out with a 6.69% cap rate. And what that means is basically, if I was going in to price a building and I say, okay, well, there's a net operating expense for $46,000, and then I use
that's utilities, management, maintenance.
Yeah, everything that's kind of built in. And then basically I would take like a 6.5% cap rate and multiply that to see where it comes out with the price, and say, okay, well, this is what the market could be reflecting. We could go higher, we could go lower, but this is where you're looking for an actual number. So I think that it kind of gives people an idea, first of all, what the value of the property is, and then also when they're looking at it, make sure that you keep the maintenance money separate, so therefore you're not going to be spending that. Keep the separate bank accounts, have everything kind of flow through, and go from there.
Have you seen that before, where the bank accounts get mixed up, or they just all get amalgamated and it's difficult to keep track?
Well, yeah, basically what some people do, and I mean, what happens is that you'll have your mortgage for your house and the mortgage for the rental coming out of the same spot, and then so therefore the rental money and your income's all going into the same spot, and it just gets, nobody sees what the difference is. So therefore you've got this, you know, huge amount of money at the beginning of the month, and all of a sudden, you know, mortgages come out, and then all of a sudden there's, you know, nil, you know, and all of a sudden you're kind of looking at it going, well, what's going on here? And you want to make sure you have enough to cover everything, and I would say keep it separate.
Okay, great advice. Thank you so much.
No problem.
All
right. Real estate tips brought to you by Matt Lee of Royal LePage.